We've got clients that come to us with ULs and different policies that are not structured the way they wanted. Our goal always is that our clients, of all of their assets, this is the one they understand the most. You should not sign a policy that you don't understand inside and out.
You're going to take care of some life protection for your family, and you're going to take care of the savings component that's going to protect your capital in a secure place. It's going to expand incredibly. And then with that, we take over the banking function, which is really what this is all about.
What I'm doing is controlling the banking function, and I am breaking my family free from dependence on.
All right, we're back. Same clothes, same place.
Same bad channel.
Same bad channel. In the interim here, we were just talking about our trades and our low stress trading stuff here and what we did this week. And we each earned, starting with small accounts, as we're still getting better in this. And I know I plan to put some massive inputs into it next year, early 2026, but $500 this week, another cash increase into our account and premiums.
Yeah, this is a game changer, boys.
It really is.
This is it. Like, this is, even if it works 50% as well as advertised, it's a total trajectory change for what I'm anticipating, what I'm like, the goals that I have, the plans. I mean, this is just an accelerator bringing everything forward. It's really powerful. So hit us up if you want to explore it, because man, I'm going to be focusing on this for quite a while. I listen to a ton of content at 2x speed, and I fly through a set, maybe 10, 15 different podcasts, and I paused all of that to focus solely on the old calls. Yeah, and just learning this, trying to absorb as much as I can. The rest of this year is going to be all learning this, and I feel like by the end of this year, it is going to be a total different trajectory. So really excited about it. And Brian's working on, we've got the remnantfinance.com/options, that page that Brian built. So we can, if you want to check that out or get on our calendar or chat with us about it, it's really cool. So
yeah, it's super good, man. I'm already up in a very short period of time of a couple $1,000s. And the cool thing about it is that's not a couple $1,000s in a stock value socked away. That's a couple $1,000s that if I needed to take out could be income to me. I'm choosing to roll it back in to continue to expand this portfolio. But ultimately, like we talked about on the last episode of with Parkinson's law, we were talking about not waiting all the time. Right before we got into that, we talked about not waiting to live your life, because you don't know when it's going to end, as we were talking about Charlie Kirk's assassination. And that's one of the game changer things about this is, in a similar fashion like what rental real estate does, although I think that this can just accelerate so much faster than that. You can get to a point here with a relatively small income. Like, the goal of that low stress trading is to take 1% profits per week is the goal. So if you're doing that and you have a $100,000 account, which is not something that will be crazy to grow to, even if you start with a small account of 5,000 and put in an extra 25, $50 a week, you'll be there in 5 years, easy, maybe 6 years. I don't know. But if you have a $100,000 account, you're talking about $1,000 a week of premium gain if you hit your 1% target. Almost everybody in there is doing more than 1% target, and they've been doing it for, some of them, up to 3 years now. You often hear people saying I'm averaging 1.3, 1.4. That kind of tends to be right in that neighborhood of what people average over time. But at 1%, that's $1,000 a week. So if you could so choose, off of just $100,000 basis, to take half of that to spend. We're talking about grocery bills doubling in the last couple of years. What if you could add $500 to your pocket and then still have $500 rolling in to continue to compound within that system? But you start pulling $200, $300, $400 a month to live on now, to go enjoy, to go do something, to take a day. And like you said, like you mentioned last week, like, hey, let's go hiking today. And we're going to go out to lunch and dinner, and I'm drawing $400 from here because I increased it by 1,000 this week. Like, it literally can partially defeat Parkinson's law, like we talked about, but can change your life and your lifestyle at the same time and give you more income to live on now and more income to grow for later. It's phenomenal. I'm super excited about it. But anyway, we didn't come here to talk about that. We came here. What's that?
Yeah, no, it's something that we're spending a lot of time on, so it's front of mind. But once you see those returns, and the final point I'll make on that is we're talking about realized gains at the beginning of the week when you make your trades. That
Monday's
money's
payday.
in your account. So it's like today's Tuesday that we're recording. We already both know how much we made on the week at a minimum. We can't lose that money. Now there's a scenario where those contracts, if the company were to go out of business, like there is a scenario, there's a worst case scenario if a company actually goes out of business. But otherwise, even then we still made the money that we've made this week that is cash in our accounts right now. It's not like buying a stock and if it goes up over the course of a week or a month or a year, your value of your brokerage portfolio has gone up, but not your cash hasn't gone up. But that's an unrealized gain, right? And there's a place for those. But when we're talking about these returns, we know as soon as Monday morning comes and we make our trades, we know what our realized gain is for the week. And now
Yeah, that
getting
cash
more
in
into the
the account.
strategy, it can go up throughout the week, but it can't go down. It's
Yeah,
really cool.
and if the strategy calls for it and you have to make an adjustment, you typically add to that.
Yeah.
It will add a little bit more money to that throughout the week potentially if the strategy calls for that. And yeah, that's like you said, that's cash in the account. Now, right now, I'm choosing to just hold that cash, and next week it's being utilized to do further trades so
Yeah.
that it continues to compound. But like I mentioned before, I could, Monday, that within 10 minutes of placing the trades, I can ask for a withdrawal straight to my checking account of a
Yeah.
portion or all of that if I wanted to. And it's available as cash to spend to me. We're not going to talk about the tax implications and all of those things because everybody has a different scenario, but you'd want to account for that. But yeah, I have it's extra cash to live on every month. And I don't know a lot of people that would hate having a few extra $1,000 a month.
Yeah, for sure.
And
And
someday tens of thousands of dollars a month.
And speaking of self-perpetuating, self-sustaining systems, we're going to get back to talking about whole life insurance, the most powerful asset that it's not should not be the only asset you own, but as far as the versatility and the ways that you can optimize using this tool and make everything else you're doing more efficient, we are going to talk about non-forfeiture options and PUA. We're going to be kind of back sort of a under the hood kind of episode where we talk through some of the basics and some contractual language that comes up pretty regularly. Every time we do a policy review, for instance, before a policy goes in force, we have this conversation about non-forfeiture options because a very common question is, well, I don't want to keep paying this huge premium until 95 years old. Why can I, like, what are my exit ramps? What if I'm not making income? What can I do other than paying this premium? And we make the case once you see what this premium in versus cash value growth, what that difference is and how that grows, if you truly understand it, you can't pick a year where you would want to stop paying premium if you understood what you have and the momentum that you've built and how it continues to grow. So you shouldn't want to stop paying premium when you understand what premium is doing for you, but it's a natural concern that people have. What if I lose my income? What if I can't afford to pay it? Or what if I just simply don't want to? So what are my options in that case? So that's what we're going to cover today.
Yeah, and even beyond that, like you mentioned the long-term implication, people think they might not want to pay it when they're say 65 and older. But I even have people that ask the same question of like, I only want to have to pay into this for 7 to 10 years and then not have to pay anymore. How can I do that? Like, they want to look at this as a short-term place because there's a lot of language out there in policy design about having the maximum inputs of cash value to be able to use to do other things. And they want to be able to do that as fast as possible and get out of it. We don't think that's the right way of thinking, but it is a way of people are thinking. And when you practice infinite banking, you're the one in control. So if you so choose to make that your MO, I will advise against it. I'd rather see you, like Han said, it's going to be extremely powerful down the road if you keep paying the premiums, and that just amplifies over and over and gets better and better. But hey, if you so choose to want to stop paying premiums in a few years, there are ways to do that. There are ways to do that and not snuff the policy. There are ways to do that and snuff out the policy. So there's four major contractual non-forfeiture options. There's the You can close the policy for cash surrender value. You can do something that we're going to define these as we go, but you can do something called a reduced paid up insurance, commonly just called an RPU with a policy. You can convert your policy into extended term insurance, or you can use the cash value to do an automatic premium loan where the company will automatically take a loan against your cash value and pay the premium with it. So those are the four major ones, but we'll even talk about other ways to potentially, or one other major way to pay the premium.
Yeah, those four, like you said, are contractual, required by state law to be in there. Going back 100 plus years, since we have such a long history with this product, there was a time where there wasn't any cash value. If you surrendered the policy, you just walked away from it. Then they started adding cash value, but there were scenarios where how do you determine who gets that cash value? And without going into all of the scenarios outlined in like a legal aspects of life insurance textbook like this one, there there came the need to have different ways for a policyholder to walk away, because basically when you think of what cash value is, it's your equity in the policy is a simple way to think about it. And so if it's your equity, like, yes, this contract, this future promise to pay is for a larger amount down the road, but I, as the policy owner, have some stake in that today already. That is my cash surrender value. And so there was a period where you could surrender it for the reserve value that the company had, the cash value, and walk away. And they've added these other options since then as a means, with the idea that it's in everyone's best interest for there to be, one, for there to be coverage in place of some type, and two, that you don't want to have people paying into policies and have nothing to show for it forever. And so if we let's just do a quick refresher on what cash value is, because it's different. We have a whole episode on this. We have an article on the blog, but what is cash value and why is it different than our what we think of as just a cash in the bank, or any other dollar denominated accounts that we have, because this matters in having this discussion.
Well, the whole life insurance policy in itself is, like you mentioned, a future promise to pay. It's a future cash flow. Upon your death, they're contractually obligated to pay you a certain amount. Your end of that contract is to continue to pay premiums. Other than that, it's called a unilateral contract. So they uphold all the terms. You continue to pay premiums. So when you think about that, as you're paying premiums over time, the company's taking that, doing what they do with it, investing it, planting it in different places, building their own cash reserves, et cetera, et cetera. So over time, it's sort of considered, well, let me start with at whatever age your policy ends. Most of them are 121 years old in America now. Some of them are 100 years old. There used to be like even different than that, but 100 or 121 depending on the companies. At 121 years old, they say it endows. So that would be like the final mortgage payment on your house. You have all the equity in the policy. So your cash value would equal your death benefit. And they would be like, hey, every obligation is paid. We're going to hand this to you. And that kind of sucks, because then there would be a tax implication because you've gotten more than you put in and you're still alive. So if you live to 121, I guess that's a blessing, but you're going to pay some taxes for that. However, because you're paying those premiums through time, there's a net present value of the policy. You've done your part of the inputs, and the value of the capital that is equivalent, to the time value growth of that future death benefit is growing with it. So just, I honestly think the easiest way to compare this, you mentioned earlier, is equity, like in a house. Every time you make a payment, you get a portion of the value of that house is now paid for. So every time you make a premium payment, a portion of that death benefit is now paid for, only it's going to be at a much more accelerated pace than it is in a standard mortgage contract. So as you build that equity, that net present value, it's what it's worth today with the time factor built in to that future payout, which is the death benefit. If you decide to take a cash surrender, if you decide to take the cash surrender value, they'll say, hey, you've paid in for, let's say, 5 years after all the expenses of starting the policy and the time value of the money you've input and what we project to do with that. Here's the actual equity or cash surrender value of the policy. If you want to terminate the policy, we'll give you that equity in the house. Just like if you sold your house, and if you sold a $500,000 house and you've only been in it for a couple of years and it's currently worth 500,000, your mortgage is 460, you don't get $500,000 plus the 40 grand in equity you have. They write the check for $500,000, and the first thing it does is pay off the loan, and you get the equity, the 40K. So this works the same way. If you surrender it, they're going to give you that accumulated cash value minus any outstanding loans, minus any fees, and then your coverage ends. Your death benefit expires upon that day.
And that speaks to the common intentional misrepresentation by the Dave Ramsey types, where they say that the company keeps your cash value, they give you the death benefit, but they hold on to the cash value. There's no way that that he doesn't understand that the cash value is the death benefit. It's just at different time frame. The future value will one day become the present, whether we live to 121 or whether I die tomorrow. That future value, the date of that payment is unknown, but the amount is certain.
Mm-hmm.
At a someday in the future, guaranteed, that future will jump from the future all the way like to the present, and it is self-completing. And so what is that worth today? Obviously money payable down the road is worth less today, right? Otherwise,
Yep.
if I could just surrender for the whole death benefit, then I would just be, they would, that doesn't even make sense, right? And so it's not that these are two separate numbers and they give you one or your beneficiary one, but they hold on to the other. That's not, that mechanically, legally, actuarially, logically, that's not what's happening at all. And so when we have that cash surrender value, that analogy of I'm selling my house, I have an equity position in the house, but I don't have the entire house paid off. Let's say the example you have a $460,000 mortgage and the house is worth $500,000. You would say that your equity is $40,000, right? But if you go to, consumer goods, the example that Ryan Griggs uses is the Costco TV. You pay $1,000 for your TV at Costco, and you want to return it. If you've paid the full $1,000, your equity in that TV is complete. So you would get the full $1,000. Vice had you paid it on an installment plan, for instance. This is a good way to kind of break down this analogy and visualize what it means for something to be paid up. So, and we'll jumping forward to the PUA discussion, that is like buying that TV in full for the full $1,000, whereas your base premium might be like buying the TV on an installment plan. How much you've put into it relative to the total value is going to be different depending on the frequency of your payments. That's why in year one, you're going to have no cash value from your base premium, because think about what the company's exposure is. I pay, in my example, I pay my $50,000 annual premium and I die the next day. My wife gets $1 million, right? So their exposure there is enormous. But if I've been paying, and now that's not a good example because that most of that is PUA, but in my case, I'll say the $14,000 is my base premium. My wife would get that $1 million. But if I've been paying for 10 years, and not only have I been giving them my $14,000 a year for 10 years, that in and of itself has reduced their exposure. But on top of that, they've been taking that, and at first in year one, they're paying off the expenses of getting this policy in force, and beyond that, they're growing that money as it comes in and compounding. And so it makes sense why their cash value would go up over time, because their exposure is getting reduced. The reserves they need to hold on in case I die prematurely is the likelihood of that and the expense of that relative to what it's going to cost them, or the what they have versus what they'll owe. It gets less and less over time. So just functionally, that little refresher on what cash value is will play in here, because that first surrender option, or the non-forfeiture option you mentioned, is surrendering the policy. The cash surrender value is what it's called, but that should sound familiar because that's also cash value. It's the same thing. Now,
Yeah, we
you could
actually
have,
just the technical
yeah,
term is cash surrender value
yeah,
legally.
and you could have a few like unused premium, like that number could be tweaked a little bit if you actually say, hey, I want this now. There are a few things in there, like partial premium payments that you've made. If you've paid a full year's of premium but you surrendered 2 months into that year, the cash surrender value might be more than the cash value available. Like it's gonna, but essentially, yeah, we've removed the word surrender in talking about cash value, because either way, we're talking about the equity, whether you're going to keep the policy and let the policy grow and that equity is going to build into the future value of the death benefit, or if we surrendered early, I'm just going to take my equity and walk away, just like I sell my home and I only get the $40,000 difference. That's my actual share in the home's value at that time. That's the
And so
cash
yeah,
surrender value.
so the first one, to take the cash surrender value, close the policy. The policy's done. You have no death benefit protection. You have no possibilities of practicing infinite banking, taking over the banking function of your life at this point. Is one we don't typically recommend unless the situations call for it and they're more dire to have that cash than it is to have the policy. So it's at the bottom. We hardly ever talk about it. We don't recommend it. It's not good. The next one that we typically don't recommend, but there are extenuating circumstances, is extended term insurance. So what they do with this is your existing cash value in the policy is used as a single premium. So it's like a one-time payment. The company's just going to keep that, and they're going to buy term insurance with it. So someday it's going to expire, and that term insurance is going to be equal to whatever your current death benefit or your original death benefit is. So they're going to, if you had a $250,000 death benefit, they're going to say this is a $250,000 term policy now. And based on how much cash value there was, it's going to determine the life based on, all the metrics, how old you are, what your ratings were, all those sorts of things. Well, you have X amount of cash value. I don't know what that is. If this were a term policy for that person starting now, how long would that pay for it? Because price is going to increase as you get older. But the point is, as long as that cash value can sustain that term policy, it will exist at the same death benefit. It could be years. It's unlikely to be an entire lifetime, a naturally occurring mortality age. And once that term expires, once again, you're out of coverage.
Yeah, and this contrasts with the next option we're going to talk about. One of these options, extended term, it keeps the amount the same, the dollar amount the same, changes the time frame. The other one's going to keep the time frame the same, i.e., whole life, and change the dollar amount. But an analogy that kind of came to mind, if I'm trying to force it, talking about the selling the home example, you have that $500,000 home, your equity is 40K. Someone buys the home from you, and if you're just going to walk away, that surrender value would be taking your after the mortgage is paid off, you get your check after closing costs, everything, and you just get a check for 40 grand. That's surrender value. That's option one. Option two, we're talking about here. Now, this isn't a real thing, but let's just imagine. What if you went to the homeowner and you said, "Hey, you're buying my home for 500 grand. I'm going to get a check for 40. We're going to pay the bank off for 460. Now you own the home." But rather than me moving out, what if you just took my 40 grand equity? I give it to you and you let me stay here as a tenant paying rent for as long as this 40 grand will allow. So let's, of course, this is not a real scenario. I've never heard of anything like this happening. But if you were to do that, you'd say, "Hey, I'm staying in the same home. I'm keeping the same value of my living situation here. I have the same exact home. Nothing's changed here. But instead of paying towards it for my whole life and owning the asset, now I become a renter of this home, and I'm using my equity in the home to fund that rental for as long as it'll last me." So the value stays the same, the death benefit stays the same, the home value that my home situation stays the same. The length of time that I have it for changes from my whole life to becoming a renter. And the homeowner would say, "Okay, well, yeah, 40 grand, here's what I would be renting it for. You can, based on the 40 grand, I calculate that you can live here for 8 years without, based on this," right? That's kind of a loose analogy.
Yeah, it's actually not bad. But the key thing to think about on both of this is that you no longer owe any premium. So
Yep.
in that one, you don't owe rent out of pocket. The equity that you had in the house when you sold it, for your example, is just paying for that rent. It didn't even cross into your hands in that scenario. The new owner got that 40K somehow through that like false transaction, and you're just getting to live there now as long until that expires. So same thing on the reduced term insurance. You don't owe a yearly premium or I'm sorry, the extended term insurance. You don't owe a premium on that. It's already paid. It's just going to keep death benefit coverage. And that time factor is going to vary for everybody based on when they exercised this non-forfeiture option. Because if you have a lot of cash value, it's going to carry out longer. If you have a little bit of cash value, it might only be a few years. I don't, there's no systematic way for me to describe how long you will have term insurance. It would be dependent on every single individual policy.
Mhm. And
Um,
those are written into the contract. Like you can see, based on the guaranteed cash value of the base
yeah,
premium only, you can see exactly a chart. At year 10, you can take this surrender value if you just want to walk away. You could have a term policy for the full death benefit for 18 years and 7 days, or you could do the next option we're going to talk about. Between those
yeah.
two, the
And
surrender and the ETI, the extended term,
well,
they're not. Yeah, go ahead.
I do want to say on that though, like almost, I always tell people whenever we first do a policy review, the first thing I say is everything on this page is wrong.
Mhm.
Like this is just an illustration. It's the same thing on that illustration or inside that policy. Because if you are practicing this for our clients, not for everybody, if they're just paying a full base premium, that is true. That is accurate. But if it's a dividend paying whole life insurance, dividends are going to PUA, and you're paying paid up additions. If we've had this specially designed for the infinite banking, all of those metrics are wrong because you're going to have a totally different cash values than what's guaranteed.
Yep, for sure.
So they're only a rough wag, but it does give you an idea of like what you could do there. And again, we don't normally, under normal circumstances, recommend converting to extended term. But if you want to keep the death benefit and you can't afford the policy, it's an option. There are there are
Yeah.
there are circumstances where it could make sense.
Yeah, we can just say that I couldn't rank them which one's worse between the two, between surrendering and extended term. I can say that those two together would be less optimal in almost every circumstance. But let's say you have a large whole life policy in place already, you don't need this extended term. Like there's a scenario where you would just take the surrender value if you're trying to get out of a policy. We've got clients that come to us with ULs and different policies that are not structured the way they wanted. For instance, if you wanted IBC and you went to an advisor and they said, "Oh yeah, I've read that book. I can get you one of those," and they put you in a product that doesn't have a PUA rider, for instance, you could surrender that policy. You're not going to have any cash value because you 1 year in, you don't have any, you've only paid base premium. But if you do have any cash value, you could just surrender that rather than taking extended term. So there's a scenario for each, but in general, we would prefer ourselves and most situations for our clients to go with the third or fourth options we're going to cover here. So what's the third option?
I'm gonna kind of go out of order than the way I first described them. But the next one I would say is automatic premium loan. And I actually describe this to people because sometimes people take out a large policy and they're like, well, what if something happens and I can't pay this in 3 years and 4 years? And it's like, well, if you've paid your PUA, this is an option that exists to keep the policy in force and not have to require anything out of pocket that you can make up for later when your life restabilizes. So this one can be very viable. And I think it's mostly viable when something disrupts your income in life and in the early years of the policy, which could happen. Like none of us know what's going to happen. None of us know if we're going to get into a car accident and we're going to have 8 month period of not earning any money. And so I think in a dire situation, the next one, the automatic premium loan, is a viable option to keep your policy in force. Not a preferred option. I'd rather you pay your premium, but if you can't, this one works. And so what it's not technically even a non-forfeiture option, but the companies we use do include this. So what happens is if you don't pay your premium, and this actually will happen if you have a memory lapse and forget to pay your premium. The company's going to if you have some cash value built up, which you should if you're practicing infinite banking with a policy we designed, it's gonna just say how much cash surrender value do they have, how much cash value is in the policy, and it's going to take an automatic loan against that cash value and pay the premium with it. So you're now going to have a loan balance, but your premium is paid. And don't forget, when your premium is paid, what goes up? Cash value, especially if you're beyond year two. So your cash value is going to increase significantly. So sometimes they'll actually, if you're into the fourth and fifth year of the policy and this unfortunate thing would happen, you'll actually see that your cash value can rise above what the loan balance is for quite a few years. So it's just an automatic loan to cover your premium. It keeps the policy in force, which is the important part, as long as you do have sufficient cash value to cover the full amount of that premium payment, the base premium payment.
Yeah, there's an assumption that it's the best for both parties for the policy to stay in force. For you, because we want to keep that protection in place, and for the company, because when policies are surrendered, it's not like they made some premium and now they're off the hook for that death benefit, so they can, like, it's a win-win for them. No, like they don't break even on a policy for many years on a whole life policy, and they want to have these policies in force because their numbers are actuarially structured. The premiums paid are actuarially structured for the risk that they're incurring. And so having these surrenders is going to throw not throw everything off, but it's going to alter the numbers. And so other policyholders will be paying the wrong amount of premium had this policy been allowed to go till the end. So on both sides of the equation, it's the law assumes that it's best for both parties for this to not lapse. And so
Yep.
that premium loan is not a non-forfeiture provision in and of itself, but if you have it, if a company offers it, which most do, and everyone that we work with does, it's the default option under that assumption that it's best for the policy to continue. And they'll take that loan, and then if you don't have the cash value, then they'll go to the extended term or the RPU. But the thing to note and remember, if you're looking at your illustration, you're having a conversation with us, we're talking about policy structure, you've got this big policy, 75% of that premium is PUA. You can't take a policy loan to pay PUA premium. The company won't actually allow that. You could get around it by saying, I want to take a policy loan, the money hits your account, and then what you do with that money is up to you. And if you want to pay PUA, you could do that. But because the policy loan incurs interest and because the PUA has the load charge, they're going to say, hey, you're going to take a double hit here. Why would we lend you money directly to pay PUA ourselves. They'll do that for base premium. You can just log in and say, I want to take a policy loan. And in one of the options there, you just click pay base premium. And base premium includes the riders, but not PUA. Because that is an option in here. You can use your cash value to via loan to pay premium. But just note that you can't do that on the PUA. But the other part of this, when we're thinking about, because the question that people are always asking, looking for exit ramps, in my example, if I'm paying 50 grand a year, only 14 of that is the base premium. With my riders, it's about 15. And so we've got, I might have cash value, but in my mind, if I think like, well, I don't have enough to pay 50 grand of premium. Well, I don't need to pay the PUA. Remember, the PUA is optional. The PUA is the warehouse for your cash when you have cash that you need safely stored and optimized. If I'm in a situation where I can't come up with that 50 on my own anyways, I'm not going to be paying the 35K of PUA that my policy is illustrated for or is structured to be able to take. I only need to come up with the base. So we focus on these larger numbers because that larger number includes the PUA, but we need to remember, if we're in a situation where we're having trouble paying this, or if we've come to this point that we're even having this discussion, you're not paying PUA anyways. You're already not paying PUA because you're having trouble coming up with the base premium, or you're uncertain if you want to keep paying the base premium. So PUA is off the table. So just remember, when you're discussing this option, you only need to focus on the required portion, which is why one thing in our planning conversations, we're big on making sure that that base premium, the part that's required to keep the policy in force, is a sustainable, manageable number that's not going to keep you up at night. Right. We want to pay big premium because we're capitalizing a system. Every dollar we put into this gets locked away, guaranteed, still accessible, but guaranteed to grow. Like all the benefits we talk about, we're just putting money into our family's bank that will return to our family tax free many times over. There's a lot of reasons we want as many dollars into these policies as we can in our family banking system, but we have to make sure that the part that's required, i.e. the base, is manageable and sustainable and is not something that's going to keep us up at night. And so you have to scale down what you're used to. Like if we have this whole planning conversation talking about 50K and only 15 of its base, when we're on this part of conversation, if we are looking for exit ramps here, remember your cash value, if you're doing this APL option, only needs to support that base premium, not the entire amount.
Right. Super important. So I think that's good. So the next one is one that I see in circles and I see in like Facebook groups and things that's pitched all the time, and it's the RPU. And there's even some companies out there that design their policies with the plan of doing this. I'm not for that. I like the long-term thinking of this. I want to be paying into my policies when I'm 80 because the return on the dollar is absolutely phenomenal the older you get. But this is a very viable and this is the most useful of the non-forfeiture options in my opinion. Reduced paid up insurance. So when you exercise this, which you can't do in the first 7 years, so this is more of you got to be thinking ahead. What you're essentially doing is the company, you're going to say, hey, I want to RPU or do a reduced paid up, and the company is going to look at what you've paid up to that point. You can do this in say years 8, 9, 10, whenever. You can do this after 20 years. They're going to look at all the premiums you paid, and then they're going to say, okay, this is the very basic wagged math for this. They're going to look at everything you've input into the policy and say, if this was the input that we had expected for the full term of the policy, how much death benefit would that have purchased from the start? So you opened a policy with the plan to pay for the next 50 years, depending on your age, 55 years maybe, but you chose to only do 15 of them. So if that total sum of premium you paid in those 15 years had been the total sum for the whole life of the policy, it would have purchased this much death benefit. And so now what they're going to do is they're going to reduce the death benefit all the way down to that level. They're going to close one door to the policy, and that's the in door. So it can never accept another premium payment. It's paid for. It's a completely paid for policy at that point. You can put no more money into the policy. It's a one-way policy at this time. The nice thing is it stays in force. It stays in force at that reduced death benefit option. So your death benefit will be lower than what you had planned. You never owe another premium on the policy. However, the good thing about this, and the reason it's a viable option, if you can no longer make your payments, is that the cash value continues to build. It continues to pay dividends, which continue to buy paid up insurance, which still does expand the death benefit from that new starting point. And the other good thing is, like I said, it's a one-way door for premium, but for loan capability, it's still a two-way door. So you could still technically practice the infinite banking concept with that. You have access to your cash value via withdrawals, or which we don't, which is not our primary method of getting cash out of there. But more importantly, you still have access to that cash surrender value via a policy loan. So they'll still issue a policy loan, and you can still, it has the exact same policy provisions or policy loan provisions that we've discussed, on prior podcasts, where you can then repay that loan at will on your schedule and still take over the banking function of your life. So if you were in an absolute dire need to never pay your premium again, of the 4 contractual non-forfeiture options, I think this is the best one. But you have to have a somewhat mature policy, which is the one little caveat.
Yeah, this is the inverse, like we talked about the extended term, where the dollar amount stays the same, the time frame is reduced. Here, the time frame stays the same, the dollar amount is reduced according to what you put in. Obviously, under the goal of still wanting to have life insurance, which we think that everyone should be fully insured to their human life value, we want to keep the policy in place for our whole lives, because permanent insurance, all that matters when we pass is the policy that's actually in force. So term has a place. We both have term policies, but we want permanent coverage. So I would rather put permanent coverage in place via RPU than take an extended term. I like the fact that I can still borrow against it, that the death benefit is still going to grow. And remember, the cash value will grow because the cash value ever marches towards the death benefit, right? If there's a future larger amount, inherently the value of that today is less. But as that gap decreases by the passage of time, the cash value must increase. And every time we get those dividends, we continue to increase the leg up that the death benefit has, which means the cash value is going to grow to meet it. So this is a super powerful option. And yes, there's a lot of talk in I'd say even in the IBC, not the Nelson Nash Institute space, where you should be getting your IBC guidance from an authorized practitioner, but in the TikTok IBC world, I'd say, where people at least understand the power of life insurance and talk about the attributes of life insurance in a way that's more intelligent than your Dave Ramsey types, where they either intentionally misrepresent it or just don't understand it at all. We're at least talking about the power of this asset, but then we're chopping it off intentionally with the idea that it's more important to not pay premium and these living benefits are more important than the banking function. And that's why that philosophy you'll never hear that from an authorized infinite banking practitioner, because we view our premium as capitalizing the banking system so that we can take back control of the banking function from financial institutions and we can become our own banker. Well, if you do that for 7 years just to get some tax benefits and just to get access to policy loans on a small amount, you truncate your policy, chop it off at the knees. It's like, well, yeah, you still can do that to an extent, but okay, you're probably still relying on banks. And so philosophically, it doesn't line up with what we want to do when we're setting up an infinite banking system. When someone comes to us and says, I want to practice IBC, I've read Becoming Your Own Banker, there's things that just don't make sense philosophically in this approach. But of those options, if you get to the point where you cannot pay it, it is one of the better options. It's on the between this and the automatic policy loan that keeps some permanent coverage in force. And so I think that there is a time and a place for this, and you can illustrate this. You can actually, on the illustration, your agent can go and set up a year at which the policy would RPU. Like Brian said, it can't be before 7 years, because if we understand what the MEC rule is, it should make sense why if you pay this policy up in 5 years, for instance, you're going to violate the 7-pay test, which says you have to pay for at least, you can't pay quicker than 7 years. So starting at year 7, you could illustrate this to RPU at year 10, and you could see the numbers of what you would have. And so you'd say, okay, I'm planning to pay for this death benefit for 10 years at this premium, but if I RPU it at this point, here's what the death benefit would be reduced to, and I can't put anything else into it. It's inconsistent with our messaging and our belief on the power and utilization of this asset, but it is an option and you should understand it. Our goal always is that our clients, of all of their assets, this is the one they understand the most. They should be able to explain these rights to their friends to someone else who's interested. Hey, why are you doing whole life? It's a terrible place to put your money. Like, we want our clients to be able to understand their contract fully. And so this is part of that effort, even though it's hopefully a conversation that you never have with us. Hey, what are my non-forfeiture options? I need to get out of this policy. We hope you're not in that situation. But if you are, it's best to understand these options and not just take, oh, 36 years term, that sounds good, I'll take that. Or, hey, I don't have to pay anything else into it, I just chop this thing down, that sounds good, I'll take that. It's like, we understand the options and know why one makes sense for you over another. And with that, we've got one more way that we can do this. That's not a policy, that's not a non-forfeiture option, but what's our fifth way that we kind of put an asterisk on, which is probably the best way to handle this, in my opinion.
Yeah, I think that if at a certain point in your policy, and they're all different based on company design and all kinds of things, but it happens relatively soon that the dividends, at least the projected dividends, because dividends are always shown based on the time you open the policy, but they go up and down. But there's a point in time, especially if you designed your policy to utilize the infinite banking function, you worked with us, where your dividends are going to exceed your premium. And there even comes a point where your dividends probably exceed your premium with PUAs.
Mm-hmm.
But let's just look at the base. So if somebody said, I don't want to still incur this, they're still viewing it as an expense rather than more of a pass through. So the person still can't get it out of their mind. Like, oh, I owe another large check this year. What is your dividend? If your dividend, you can use it to pay part of the premium and reduce the cost of your premium, or you can use it to pay all of your premium and probably at a pretty quick point have more dividend available than the cost of your premium. So some of that dividend still goes to expand your policy and buy more PUAs. But if you absolutely 100%, or let's not even when you're young, but maybe post age, we'll call it 65, you decide that you want to retire and your income drastically decreases because you followed a standard plan, and you're like, hey, I don't want to still have this large premium payment. Well, you can convert your dividend into premium and pay for the policy, and it will be a self-licking ice cream cone at that point. Every year it's going to kick off a dividend that size or might likely larger, and every year you just say, hey, pay my premium with a dividend. It's one click of the button right now in today's world. Super
Yeah, and
easy.
a couple notes on like some of the illustration mechanics here. So I just pulled up my policy. I'm not going to show it on the screen because we don't like. I'm very transparent with the numbers of my policy, but we don't like to do, you know, we don't like to sling around illustrations and try to get, because that conversation should happen once you have a foundational understanding and a background and about the what and the why. We're not just trying to show numbers to say, hey, look at this, but these numbers are impressive. And if I look at my illustration, by depending, if I count my base premium as my face, like the base face amount plus the riders, by year 8 my dividend projection is larger than that amount. In my case, I pay 50K a year. I'm gonna rough, like kind of rough numbers here. 30% of that is base, 70% is PUA. So we'll kind of, we'll make it a little smoother numbers. 15 grand is the base premium, 35 grand is the PUA. By year 8 my dividend is 15.9. By year 7 it's 14.3. So I'm kind of getting close there. It's not going to be exactly that. We know that the second we hit print, these numbers are not not going to be exact, but we also know that within a standard deviation we feel pretty confident that we're going to get performance that's somewhat in line with this. And in my case, every one of the 4 years I've had this policy, the dividend's actually been larger than it was projected to be when the illustration was printed. But that's not saying that it's going to continue. But anyways, if you structure your policy in the realm, the breakdown of PUA versus base that most of our clients have and opt for, which is somewhere in the 20% to 40% base, I'd say is probably 80+% of the policies that we write. You can expect that within the first 10 years, you're going to have a dividend that can pay your base premium. And if we think about that, if I'm at year 8 right now, that's the first year I could do this RPU, because remember, I have to pay it up in 7 years. So I'm looking at year 8. I paid for 7 years. So now I have the right to RPU it, but that is the first year that my dividend is larger than my required premium. So why would I even do that? And so this option is great because if I look at my policy, if I look at the non-forfeiture option there, the, I could take this $1 million death benefit and cut it down to a fraction of that. And I guess now I have that. I have this little dwarf policy that's still, alive, but I can do a little bit with it. But if I keep this active, I have a $1.6 million death benefit. I have $400,000 of cash value, And those numbers only grow from there. Now, the other thing to know when you're looking at illustrations, if my illustration assumes that I'm taking that dividend in year 8 of just shy of 16 grand and purchasing more insurance with it. By moving it over to the death benefit column, by purchasing insurance, I then draw the arrow over to the cash value column because I purchased about 16 grand of cash value, or I purchased death benefit. Available of that death benefit that I purchased is about 16 grand. That's how dividends, or that's how PUA works, right? You take a payment, you pay it all, a chunk of death benefit off at once, and therefore that amount that you paid in, less about 5% or so load fee or load charge, to the cost of putting that insurance in place is around 5% with the companies we use. So about 95% of that's available as cash value for me. Now, because my cash value is increased, when dividend time comes around next year, my share of the company's performance has increased slightly, and therefore my dividend increases. So if I were to look at this illustration and say, okay, starting year 8, I'm going to apply my 16 grand dividend to pay my 15 grand base premium. Well, I can't then look at 30 years from now, because if I look at the illustration at year 24, my dividend's $52,000. That's larger than the total premium, including my PUA. But if I start in year 8, putting 15 grand of that dividend towards my base premium, I'm not going to get to that point of 52 grand in year 24, right? So you got to remember, you're truncating the dividends by doing something other than what's illustrated. The optimal thing to do is purchase paid up in additional insurance with your dividend. Therefore, your dividends grow, somewhat in line with as projected. But again, we're not talking about the optimal situation here. We're talking about how to optimize with a suboptimal situation where we're trying to figure out, can I keep this policy in force? So if we're into having that conversation, I don't get to look at year 30 dividends and think I'm going to get what I have there if I'm, one, not paying my scheduled PUA, and two, divert my dividend from PUA to paying premium. But of these options we've discussed, this is by far the most optimal option when you're accepting that you're in this suboptimal decision point, if that makes sense.
Yeah, and I think that there's another key point that you've missed is that if you use the dividend to pay the premium, remember, go back when I said the RPU, you've closed the premium door. It's a one-way door, or it's just a closed door for premium, as a matter of fact. So you can no longer have any initial inputs or any additional inputs. If you are using your dividends to pay the premium, and you have to do that for a year, for 2 years, for 3 years, and you get into a better situation and you want to pay more, you could just start paying that premium again out of pocket. You can re-amplify that policy and get it rolling again. So maybe you're just in that same situation I mentioned earlier, where like you have a big hiccup in your income. So you're like, I want to start using my dividends to pay for this. 2 years later, your income increases again. You could start paying the premium out of pocket again and start paying all the PUAs like you'd planned. Now you're going to have a little bit of an upset. So just like Hans just said, your 30 is going to look very different now because you didn't pay those PUAs and you didn't pay that premium out of pocket for a couple years. But it's not going to look as drastically bad as it would have if you had just kept using your dividends to pay the premium for the life of the loan. So it's still a two-way door of premium. You can still use the PUAs the dividends to pay the premium, or you can pay them out of pocket. So you haven't surrendered any of your rights to pay premium by doing that.
Yeah, that's by far the superior option. If you were in a situation where you're having to think through this, don't just do the easiest thing and what someone's going to tell you. If you talk to your uncle who is a financial advisor or whatever, you go to Southeastern Mutual or whatever, somewhere where they look at, hey, this isn't the policy, get a policy with us. Don't just hit surrender and take the cash and walk away. There's options here, and you should understand those options. If you choose to take the surrender for reasons that satisfy you, then that's one of the contractual rights. You're the banker,
And,
but
and
we
if your
want you to
dad
understand these.
and if your uncle tells you to go to Southwestern Mutual and get a policy, say, "Nah, bro, I'm part of the remnant," and then call us.
Yeah, it's I, I I'm working. Yeah, and I mentioned it last week with Will, but everyone in the life insurance space most likely has heard of infinite banking. That does not mean that they can get you a policy conducive to infinite banking. There are the process. It's not a policy that, like, there's no IBC policy. It's a process. It's a concept, and we implement it best with a properly structured whole life policy. That doesn't mean you can't do infinite banking. As James Nethery says, you can do infinite banking with a barn full of tobacco because it's an asset that you could find someone to collateralize for you, right? That is, it's it's not the product, it's the understanding of how we use this product, and it's the company's whole life basically the way that the company allows you to structure a policy that enables the ability to do this optimally. And so please, whether it's with us or somebody else in your local area, go to infinitebanking.org and look at the practitioner finder, work with an authorized IBC practitioner by the Nelson Nash Institute, because you might find yourself in the situation that I'm working with a pending client now, where opted to go with a company that said, hey, yeah, I know. I've heard of that. I can do that. We have the same thing. We have whole life. We have a PUA rider, but wrote him a policy without a PUA rider at all. And when he said, hey, I now I'm looking at this, I told you what I wanted, but I don't have any cash value. Like what gives? Why do I not have that? Sent an illustration of saying, yeah, you could put this much into the PUA rider, but it's going to mech. Just so don't do that. So don't put this much. He's like, well, he sent me these illustrations. I'm like, why would they even have that? Why would they send you that? Why not send you the amount that wouldn't mech the policy? Well, the amount that would mech the policy was just over the amount of the base premium. And with this company, it requires a blended term rider. And none of this was explained to him at all. He had no idea what a blended term rider is. All he knew is like, I know what I want. I can't really explain it. And so this agent at the granddaddy of insurers said, yeah, we can do that. But in reality, not a single person in the Nelson Nash Institute, I'd wager, writes policies with them, because it doesn't work. The structure of their premium, the structure of their riders doesn't allow for it. So don't just assume that if someone's read Becoming Your Own Banker, has heard of infinite banking, that they can get you what you are actually looking for. You should understand. You should not sign a policy that you don't understand inside and out. And that's always our goal with our clients.
Yeah, by the way, so you mentioned that you know the dates of all of your policies, and I appreciate you paying your first one that you did with me. I got the letter saying that it was paid.
Yeah. Yeah. Yep. It was
So I
paid.
see that you're continuing to pay your premium, and that's a good thing.
Yeah, I'm already very quickly at a point. Not that it's, we don't focus on these numbers. We're not doing this for rate of return. We're doing this for control of the banking function.
Yeah.
But everyone wants to start out the conversation with, when am I going to break even? How soon do I go cash on cash? They want to have these conversations. And so I can say very quickly, I'm already there. Again, not that that's what's important. I would still be doing this if it took me twice as long to get to that point, because what I'm doing is not investing for a rate of return here. What I'm doing is controlling the banking function, and I am breaking my family free from dependence on outside institutions. That takes
Yeah.
time to get there,
And
but I'm going to get there.
you're taking care of the protection and savings component of true wealth building in one part of the protection in one step here. You're
Yep.
providing a death benefit for your wife and kids. And at the same time, you're saving,
Yep.
which is really, a thing that we talk more and more and more about all the time, is that the savings rate in America is awful. And this is a
Yep.
secure, safe place to store capital. So why would you want to stop securing your capital in the best known contractual place to store it? And then
Mm-hmm.
once you have stored that capital there, we deploy it. And like we talked about at the beginning of this episode, we're both taking this endeavor that has been incredible on a way to grow that capital.
Yeah.
So take care of the first phases of wealth, protection and savings, because if you don't protect, you really can't grow wealth. Because like we've talked about here, we're all on two parallel paths of wealth. We're on the protection path and we're on the wealth building path. And the wealth building path happens on a curve. But that you don't own that curve, you don't have a right to that curve, and that curve can be disrupted at any time. We've all seen the graphs where they show wealth on this on this kind of parabolic curve. Anything that can happen in your life can disrupt that and can completely flatten that to a point where you might have to start over, or you may never be able to start over again. Death,
Mm-hmm.
disability, divorce, accidents, lawsuits, etc. All of those things can disrupt that wealth curve. So the first thing we need to do is protect and grow it. And we're going to provide the protections through different levels of insurance, through our liability insurance, umbrella insurance, life insurance, disability insurance, etc. We're going to try to mitigate all those potential disasters that will kill your growth. So we focus first, protection and growth. This is the optimal place. I'm sorry, protection and savings. This is the optimal place to take care of two of those stones at one time.
Yep. We're
Those
not.
birds, two of those birds with one stone,
Yeah.
$1. You're gonna take care of some life protection for your family, and you're gonna take care of the savings component that's gonna protect your capital in a secure place. It's gonna expand incredibly, and then with that, we take over the banking function, which is phenomenal, which is really what this is all about. Um,
Yep.
and then, man, once you've built that capital up and you have a proper savings habit, you can do some really cool stuff out there to grow it and probably have wealth beyond what you ever considered.
Yeah. Investments don't make good insurance, and insurance don't make for good investments. That's why we'll never sell you a universal life product of any flavor. If you want that, you're going to have to go somewhere else. But we do invest. We just don't invest with our savings and our family's protection. We have different functions there. A bank is never going to make a loan or do anything without collateral and safeguards in place, and neither are we. This is our safeguard. This is our collateral. We are not taking unmeasured risks with no collateral. We're not putting our family's contingency if something happens to us on the line for speculating to get a greater rate of return. We do seek rates of returns, and we think we found a pretty phenomenal way to do that. And we're going to keep talking about it because it is just a game changer. But that is not like the options strategy we're talking about is incredible, but I'm not going to surrender my whole life policies to put money in there, because if I do that and I die a year from now, that's cool. I've made 1% a week for a year, but it's not that doesn't do my family a service. And so we want to keep a strong wall, like a very clearly defined wall between your investments and your savings. And we stay in that side of the pond as far as what we actually implement for our clients. And we just tell you what we're doing over here. But you should not mix these things together, because there is.
I will put a caveat on that. That wall has a certain height. And
Yeah.
that's your your emergency opportunity on your savings, because I am an advocate of taking these funds that you're saving over time and starting to move them over to the investment category, and that's where we get our
Oh
money
yeah.
work multiple places. So that's
Yeah. Yeah.
that he's talking about exists, but it exists to a point. It's not a wall to eternity. Yeah. So
Well,
build
and I
this
would
safe.
argue that even in that situation you're talking about, like taking a policy loan, for instance, that we're going to do, taking a policy loan to invest, that is not, in my mind, breaking this wall. What that's doing is it's keeping the savings component preserved
And
and
protected. Yeah.
growing it over here. So like it's not really crossing streams in my mind, because if my investment goes under, yes, I have a loan against my cash value, but my cash value is still compounding. My savings is still complete and is going to complete into the death benefit less that loan one day. So yeah, I mean,
Yeah.
we
I
don't
get
need
what you're
to
saying.
splitting hairs
Yeah.
on an analogy here, but we do both things. We do all of these things, but my main point is make sure, if this is what you want, that you work with an authorized IBC practitioner, because there's the right product and a wrong product for this. There's a right way that you can structure a policy and a wrong way you can structure a policy, and there's a right company to work with and there's a wrong company to work with. And people will say, well, there's no wrong investments, just wrong investors. Sure, but if you want the outcome that you're talking about, that we're talking about here, work with someone who's trained to do this, and go to infinitebanking.org or just hit us up.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.